In this video, I'll make a few quick comments and observations in relation to the fixed income market and bond markets. Generally speaking, bond markets don't get a lot of media attention, in part because the equity markets tend to steal the limelight when you think of the companies like Apple and Google, Tesla, Amazon, the personalities, the colorful quips, the lifestyles and so on of key players. Media tend to focus on the equity market, and less so on the bond markets. But the bond markets are quite big. In fact, using data from the Security Industry Financial Markets Association, we can see that the size of debt markets in the United States is in 2019 45 trillion, and that's coming from SIFMA, and that's been growing each year quite substantially since 1996. So fixed income is with us, and bond pricing and so on is something that looks to be here to stay. Key markets here would be corporate bonds, which make up about $10 trillion or close to 10 trillion. And then government issued debt, treasury securities make up 16 trillion. That this is ignoring local and state debt, which also could be about 4 trillion. And then you have federal agencies like Fannie Mae and Freddie Mac. They have a substantial amount of debt linked to. Now, if we take a closer look here at the federal agency securities, if we double click, we can see here that we have Fannie Mae, Freddie Mac, Farm Credit, and FHLB, and they all have fairly substantial numbers here. We can come back out and we can then look a little bit more closely at the asset-backed securities. And again, you can see student loans here, substantial. I don't think this is agency debt. This is private label student loans. CDOs are collateralized debt obligations, and these might be legacy debt instruments, but are credit instruments where, for instance, that there's tranching, for instance. So on the back of some asset, you issue new instruments, and you've Sallie Mae, Freddie Mac, Fannie Mae, and then there's the mortgage-backed securities linked to instruments issued on the back of mortgages. And here you may have Wall Street and so on. And we've down here we have municipal bonds as well. So this is the debt issued by the city of Boston and New York and so on. So it's a huge market in comparison to US GDP. US GDP in 2019 was 21 trillion. We'll just check that to see. Okay, so as of 2019, US GDP was 21 trillion. So very substantial market. And when we look at the equity market, the size of the equity markets in the United States, equity markets, while being very big and attracting a lot of headlines and viewership in terms of personalities, the size of the US equity market is 37 trillion as of 2019, which is 3 times bigger than the Chinese market of 11, almost 12 trillion, and the Japanese equity market of 6 trillion. Again, keep in mind, US fixed income markets are 45 trillion. So if we need any rationale for dealing with looking at fixed income, size alone would warrant us taking a look here. Debt to GDP in the United States stands in excess of 100%. I have figures here from the Federal Reserve of St. Louis, which tracks debt to GDP over the period 1970 right up to 2020. And what we observe here is relatively low levels of debt to GDP, a bit of a pickup in the 70s, declines in the 80s, and then increases during the up to the Clinton period, and then there seems to be a hump and a turnaround. So during the Reagan period, a lot of expenditure on building up military. The Cold War was still an issue. Early 1990s, a lot of that was resolved. There was a reduction in expenditure, peace dividend, and also a little bit of fiscal conservative behavior coming mainly from President Clinton. Then we had 2001, and Afghanistan and Iraq kicked off again, and this was quite an expensive war. But the big uptick then came on the back of the banking crisis and bailing out different financial institutions, taking AIG, Fannie Mae, Freddie Mac into conservatorship, and that continued during the Obama period right up until 2016. And since 2016, we have President Trump, and there have been additional tax cuts, and that also, and now we have, although not 2020, but COVID also has produced a stimulus package, and that's going to be in the probably maybe several billion added on here. So we can look at the direction here of fixed income, bond issuance, and so on. It would appear fixed income is going to be a key part of the analysis, and very big relative to equity markets, which we tend to focus on a lot, and warrants then us taking a closer look in terms of just doing basic techniques. How do we price bonds? How do we get yield to maturity? How do we construct a term structure?